You know that screen?
Oh, yeah, the white one.
Right. You're clicking a link, trying to get to a piece of information you need right now, and suddenly your screen just goes total white.
Yep. And then you get that little spinning circle.
Exactly. A little spinning circle appears, and there's that, mildly condescending text that says, just a moment, performing security verification.
Yeah. This website uses a security service to protect against malicious bots. It's like the digital equivalent of being asked to step out of line and empty your pockets.
It really is. You just have to sit there staring at this weird string of text, like a Ray ID.
Yeah.
The one in our source today is 9F057B646D231612.
What, you're just waiting for the invisible bouncer to decide you're actually a human.
Exactly. And usually you see that when you're trying to, I don't know, buy concert tickets or log into your bank.
Sure.
But the source documents we're looking at today start with those exact Cloudflare verification logs, those just a moment screens, protecting a site called MarketBeat. And what are they protecting? It's just a standard financial document, specifically the Q1 2026 earnings report for a company called Manhattan Associates. They trade under the ticker MAH.
Which is such a specific thing to have heavily guarded.
Right. So our mission today for this deep dive is to decode this really fascinating stack of sources. We're going to explore the invisible digital plumbing of global commerce.
The stuff nobody really thinks about.
Exactly. We'll look at how financial data is guarded from bots, and then how the actual movement of physical goods around the entire world is being completely rewired by cloud software.
It's a huge shift.
Okay, so let's unpack this. Before we even get to the supply chain data, we have to talk about how that data is being protected. And I have to admit, I'm a little confused right out of the gate here.
Okay, what's tripping you up?
Well, is standard financial reporting really that heavily targeted? I mean, why do we actually need massive digital gates just to read an earnings summary for a supply chain company?
So what's fascinating here is that in the modern financial ecosystem, data isn't just information about currency.
Okay.
Data literally is currency.
Yeah.
The reason MarketBeat has those heavy Cloudflare gates in front of a Manhattan Associates earnings report isn't because, human retail investors are overwhelmingly flocking to their servers.
Right.
It's because of automated high-frequency trading bots.
So wait, like algorithms that trade stocks?
Exactly. These algorithms are designed to scrape financial sites the very millisecond an earnings report drops.
Oh, wow.
Yeah, they process the revenue numbers, like Manhattan's $282.2 million for the quarter.
Yeah.
And they execute massive block trades based on that data long before your human eye has even finished reading the word revenue.
That is wild. So the bouncer isn't there to stop a crowd of regular people.
No, not at all.
It's there to stop an army of speed-reading robots trying to front-run the stock market.
Precisely. In the world of high-frequency trading, if an algorithm knows that a company beat their earnings expectations by just a few cents,
Yeah.
it can buy up shares and flip them for a micro-profit thousands of times over. It's essentially legally skimming the market.
That makes so much sense. So that Ray ID I mentioned earlier, that unique string of character.
Right, the 9F05,
Yeah.
whatever it was.
Yeah, exactly. That's Cloudflare tracking the specific request through their global network.
Exactly. The system is rapidly checking to ensure a real browser is making the request. It requires JavaScript to load. It checks cookies.
It even analyzes mouse movements, right, to prove human behavior.
Yep. If it doesn't see that human-like movement, it just drops the connection entirely.
Wow. Well, that perfectly sets up the immense value of what's actually inside this earnings report. We passed the bouncer to get to the VIP section, basically.
And the VIP here is Manhattan Associates.
Right. So we solve the KPTCHA, we get past the bots, and we finally get the report. And we see this company pulled in over $282 million in just the first 3 months of 2026.
Which is a massive number.
It really is. But for anyone listening who isn't deep in the logistics world, who exactly is Manhattan Associates?
Yeah, it's the big question.
Because the report calls them a, quote, global technology leader providing supply chain and omni-channel commerce solutions.
Which is a very thick wall of corporate jargon.
Seriously. Let's translate that for the listener. Does omni-channel just mean, like, I can buy a shirt on my phone and then return it at a physical store?
That is exactly what it means.
Yeah.
But think about the massive headache that creates behind the scenes.
Oh, I'm sure.
If you return that shirt to a physical store, the central database needs to instantly know that the shirt is now sitting in a mall in Chicago, not in a massive warehouse in Ohio.
Right.
And it needs to make that specific shirt available for a local customer buying it online an hour later. Manhattan Associates provides the software that tracks all of that seamlessly.
Okay, that makes sense. And the report also mentions they use an API-first architecture.
Yes, that's a key detail.
Does that basically mean their software acts like a universal plug for whatever 1990s cash register a store might already be using?
That's a great analogy, actually. An API application programming interface is essentially a translator.
Okay.
Manhattan doesn't force a retailer to rip out their entire point-of-sale system. Their API simply plugs into the retailer's existing software and extracts the necessary data.
So they're like the invisible nervous system.
Exactly. They connect the front-end sales, that cash register beep or that click on a website checkout, to the back-end supply chain execution.
So just to be clear, they don't actually own physical warehouses, right?
Yeah.
They don't own fleets of delivery trucks or cargo ships.
No, none of that.
They're essentially just the digital brain translating the cash register beep into a forklift movement halfway across the world.
Correct. They don't own the forklift. They provide the intelligence that tells the forklift exactly which box to grab at exactly what time to optimize the entire global flow of goods.
That's incredible.
It is. But here is the detail hidden in the forward-looking risk statements of their report that really changes the game.
Okay, what is it?
They explicitly note the risks associated with their use of, quote, generative and agentic artificial intelligence.
Generative and agentic.
Yeah. We all know generative AI. It writes text and makes images. But agentic AI is a massive leap forward.
Agentic meaning it has agency, like it actually takes action on its own.
Yes, and understanding how this works is crucial. They aren't just tracking boxes on a screen anymore.
Right.
They are deploying AI agents that can autonomously preempt global disruptions.
Autonomously.
Really?
Really? Let's say you have a cargo ship coming from Asia to Los Angeles. An agentic AI system is simultaneously monitoring global weather patterns, port strike negotiations, and local trucking availability.
Wow, all at once.
Yeah. So if it sees a typhoon forming in the Pacific that will delay that specific ship by 4 days, the agentic AI doesn't just send an email to a human manager saying, hey, there's a storm.
Wait, it actually solves the problem.
It solves it instantly. It proactively reroutes inventory within the system. It automatically adjusts the delivery promises on the retailer's consumer-facing website so customers know their items will be delayed.
That is crazy. And it might even autonomously reorder critical stock from an alternate, closer supplier in Mexico to cover the gap.
Without asking anyone.
Exactly. It makes the strategic decision and executes the commands across the API without a human ever touching a keyboard.
Wow. So the software isn't just a dashboard the human looks at. The software is actively managing a global crisis while the human manager is, like, getting a cup of coffee.
That's exactly it.
Well, that explains why they are pulling in hundreds of millions a quarter.
Definitely.
But if these AI agents are constantly monitoring global weather and rerouting ships in real time, that requires massive nonstop computing power. You can't just install a CD-ROM on a back-office computer to do that.
No, absolutely not.
And that technical reality is what seems to be driving their massive financial shift. Looking at the Q1 2026 revenue split, total revenue is up from $262.8 million last year to $282.2 million now.
Right. A solid increase.
But the real story is underneath that top-line number. Cloud subscription revenue absolutely surged to $117.1 million.
Yeah.
Meanwhile, traditional software license revenue plummeted to just $2.2 million. Last year, it was over $9 million.
It's a huge drop.
It's like watching the final death of the physical software installation. It's the complete Netflixification of industrial software.
Netflixification is exactly the right framework.
You think so?
Oh, definitely. We are witnessing the absolute sunsetting of the old way of buying software.
Right.
Where a logistics company would pay a massive upfront fee for a software license, install it on their own private servers, and just hope it doesn't break.
Yeah, the old IT closet.
Right. Now they just rent continuous access to Manhattan's constantly updating cloud brain.
Hold on, though.
Yeah?
If I'm running a software business, giving up a massive upfront check of several $1,000,000 for a bunch of smaller, piecemeal monthly subscriptions sound like a terrible idea for cash flow right now.
It's definitely a transition.
Are they just bleeding cash while they build this massive AI infrastructure? You know, you have to build it first and then wait months or years to earn back the costs through those subscription fees.
That's a very sharp observation, and it does create a temporary optical illusion on their income statement.
An optical illusion.
Yeah. This is exactly why they report two completely different earnings numbers to Wall Street.
Oh, right. The GAAP and non-GAAP stuff.
Exactly. If you look at their GAAP diluted earnings per share GAAP being generally accepted accounting principles, the strict legal accounting rules, it was 82 cents for the quarter,
Okay.
which is actually down slightly from 85 cents a year ago.
But wait, their adjusted non-GAAP EPS was $1.24, which is a massive increase.
Right.
Why is there such a huge gap between the two numbers? That's a 42-cent difference per share. How can they just report a different, higher number?
The biggest culprit creating that gap is something called equity-based compensation.
Paying people in stock.
Exactly. Manhattan Associates paid out $26.5 million in stock to their employees just in Q1 alone.
Wow, that's a lot of stock.
It is. Now think about the mechanics of the tech industry right now. Especially when you are building cutting-edge agentic AI, the competition for top engineering talent is fierce.
Right, you're competing with Google, Microsoft, all the specialized startups.
Exactly. You can't just pay them massive cash salaries. They want ownership. You have to pay them in company stock to keep them.
Right, but how does that affect the earnings report?
Under GAAP rules, you are forced to record that stock grant as an expense on the income statement, exactly as if you had paid the employee out of the company's checking account.
Oh, I see.
It mathematically depresses your official profit. But non-GAAP adjustments strip that expense out.
Because it's not real cash leaving the building.
Right. The argument is that handing an employee newly created stock doesn't actually cost the company any of its cash on hand.
It dilutes the shareholder, sure.
Yes, it dilutes them, but it doesn't drain the bank account.
Yeah.
So the $1.24 non-GAAP number is a much closer reflection of the actual cash the business is generating from its operations.
Okay, that makes total sense.
And to answer your earlier question about the Netflixification hurting short-term profits, yes, the transition to cloud subscriptions can be very painful initially because you miss out on those big upfront checks.
Right.
But ultimately, this cloud shift creates a far more resilient business model. And for Manhattan Associates, they've already crossed the pain threshold.
And that resilience is explicitly quantified in a metric buried deep in the back of this report.
The RPO.
Yes, RPO, or remaining performance obligations. For Manhattan Associates, their RPO has hit $2.35 billion.
Just staggering.
Right. And that's up 24% just since December of last year. Plus, the report notes that over 98% of this RPO is made up of cloud-native subscriptions with non-cancelable terms longer than a year.
That non-cancelable part is huge.
Yeah. So what does this actually look like in practice? Is this basically a $2.35 billion legally binding IOU from the global retail sector?
If we connect this to the bigger picture, that $2.35 billion RPO is exactly why this company is so incredibly confident about their future.
Because they know the money's coming.
You're right. It is essentially a guaranteed IOU. Let's break down how the accounting for this physically works.
Okay.
When a massive retailer signs a 3-year, $30 million contract to use Manhattan's cloud software, Manhattan cannot simply claim all $30 million as revenue today.
Oh, because of accounting rules.
Right. Rules dictate they can only recognize that revenue as they actually provide the service, month by month over the 3 years.
Because they haven't actually performed the service yet, hence the name.
Exactly. The rest of that money, the part they haven't earned yet but are legally contracted to receive, sits in this RPO bucket.
Wow.
It represents guaranteed future revenue that just hasn't hit the income statement yet.
It's like a crystal ball for their future cash flow.
It really is.
You don't have to guess if people are going to buy your software next year because they've already signed a contract saying they will.
Precisely. And look at the global context in which they are operating right now.
It's a mess.
It is. The CEO, Eric Clark, specifically noted in the release that macro volatility persists.
Yeah, that stood out to me.
The forward-looking statements in the document are filled with stark warnings about global instability. They explicitly cite ongoing military conflicts involving the U.S., Israel, Iran, and the war between Russia and Ukraine.
Right, and when you are the central nervous system for the global supply chain, a missile strike near a major shipping lane or a massive trade sanction on a major economy directly threatens your customers' ability to move their goods.
Exactly.
Which means your customers might go out of business, or at the very least look to drastically cut their software budgets.
Right. But because Manhattan Associates has locked these massive retailers into long-term, non-cancelable cloud contracts, that $2.35 billion RPO acts as physical financial armor against a chaotic world.
They're protected.
Totally. If the global economy takes a massive hit tomorrow, retailers can't just cancel their subscription to Manhattan Associates without massive penalties.
Which completely insulates them from short-term economic shocks.
Yes. It is the exact reason why, despite wars, inflation, and unpredictable macro volatility, they are confident enough to publicly project that their full-year 2026 revenue will be between $1.147 billion and $1.157 billion.
Because they literally already know the money is...
Right. So if you have a pizza cut into 10 slices and you own one slice, you own 10% of the pizza.
Simple enough.
When a company does a share buyback, they use their cash to buy those slices back from the public market and essentially destroy them. They retire the shares.
Okay.
So now that same exact pizza is only cut into 8 slices.
Ah. So the pie didn't get any bigger, but because there are fewer slices, my one slice is suddenly a larger percentage of the whole pie.
Exactly.
Yeah.
It makes every remaining share more valuable, which drives the stock price up and rewards the investors who held onto their stock.
That makes total sense.
It's a very confident move.
Mm.
It signals to the market that the company believes its own stock is underpriced, and they have so much extra cash, they don't even need to reinvest all of it into the business.
Okay, so that covers the buybacks, but then there's the global reach aspect.
Yeah.
The report mentions a massive research and development center located in Bangalore, India.
Right.
And because they operate there, the exchange rate between the US dollar and the Indian rupee literally shifts their bottom line. The report notes the total impact of changes in the Indian rupee was almost $4.5 million just for the quarter.
Which is wild to think about.
Right. How does a currency fluctuation mathematically turn into profit?
It's a brilliant illustration of the mechanics of globalized software development.
Okay, break it down.
Manhattan Associates is likely paying their top-tier engineers in Bangalore, in local currency, the Indian rupee.
Sure.
However, they report their global corporate profits in US dollars. Let's say they budget 10 million rupees a month for payroll. If the rupee weakens against the dollar, it takes fewer US dollars to buy those same 10 million rupees.
Wait, so they are getting the exact same amount of engineering work, the exact same amount of code being written, but they are spending fewer US dollars to get it.
Exactly. Manhattan Associates effectively gets a multi-million-dollar boost to their operating margins without selling a single extra software license, simply because their labor just got cheaper on a relative international basis.
That is fascinating. But here's where it gets really interesting to me, though.
Oh, yeah.
We are talking about multi-million-dollar international currency fluctuations. We're talking about AI agents autonomously monitoring global wars and billions of dollars in cloud contracts sitting in an RPO bucket.
Very high-level stuff.
Right. But when you look really closely at their non-GAAP adjustments, the specific things they exclude from their standard earnings because they are deemed unusual, you find some incredibly human quirks that disrupt all this high-tech perfection.
Yes, the adjustment section is always revealing.
For instance, in early 2025, they had to cut about 100 jobs to align services capacity.
That's pretty standard corporate restructuring.
Yeah, standard stuff.
Yeah.
But then, bizarrely, their recent financial history was notably impacted by a single unusual health insurance claim.
Just one claim.
One claim. Late in 2024, they took a massive $7 million expense for this single medical claim. Then, they got some insurance recoveries, and finally, in late 2025, they settled the claim and actually had to record a $6.2 million benefit on their books.
Wow.
Yeah, because the final payment was way lower than the healthcare provider originally estimated. A multi-billion-dollar AI enterprise's quarterly earnings were visibly skewed by one individual employee's medical bill.
This raises an important question, doesn't it?
It really does.
It completely strips away the illusion we often have that these massive tech corporations are just, flawless, unfeeling algorithms generating cash in a vacuum.
Right.
At their core, despite the agentic AI, despite the cloud-native API architectures routing ships around typhoons, businesses are still fundamentally made up of fragile human beings.
Yeah, exactly.
A company can build software that flawlessly manages millions of inventory items, but they still self-fund their employee health insurance pool.
Yeah.
And one catastrophic illness or anomaly from a single employee can throw off the quarterly earnings of a publicly traded tech giant so much that they have to write special paragraphs explaining the math to Wall Street analysts.
It's crazy.
It highlights this deep, unavoidable interconnectedness. You have severance packages for 100 people in one column, the fluctuating value of the Indian rupee in another, and a single human health crisis in a third.
All feeding into the same giant spreadsheet.
Exactly. That decides if the stock goes up or down.
It's the ghost in the machine. No matter how much you automate the supply chain, you simply cannot engineer the humanity entirely out of the spreadsheet.
You really can.
So to recap the journey we've been on today for you listening, we started at the door, frustrated by a digital bouncer.
That Cloudflare just a moment screen.
Exactly, which we learned is designed to block automated bots from stealing and trading on financial data in milliseconds.
Right.
Once we got past that bouncer, we uncovered Manhattan Associates, a company generating over $282 million a quarter. We translated their jargon and learned that they aren't just selling logistics software.
They're changing the game entirely.
Right. They are actively replacing traditional retail management with agentic AI that solves crises autonomously. And they are locking the global economy into billions of dollars of non-cancelable cloud subscriptions.
It's huge.
It really changes how you look at everyday life. The next time you order a package online and it somehow arrives on your doorstep seamlessly despite port strikes or global conflicts or unpredictable weather.
Yeah, you have to remember what's behind it.
Exactly. Remember the massive, invisible cloud architecture doing the heavy lifting. Remember the billions of dollars in remaining performance obligations funding it, and the AI agents making decisions in the background to make sure your package actually arrives.
And I'll leave you with this final thought to mull over.
Okay, what is it?
We spent a lot of time today talking about how agentic AI and long-term cloud contracts act as armor, insulating these massive companies from global chaos.
Right. The $2.35 billion shield.
Exactly. But let's flip that perspective for a second.
Okay.
If the entire global supply chain, from the cash register beep in Ohio to the forklift in a warehouse in Germany to the cargo ship in the Pacific, is entirely managed by a single, perfectly interconnected cloud brain.
Uh-oh.
What happens when that brain has a bad day?
Wow.
We have spent billions engineering human error out of the logistics system. But have we simply replaced human error with the terrifying risk of a single, catastrophic global glitch?
That is a scary thought.
The next time you see that just a moment performing security verification screen, ask yourself, what happens to the physical movement of goods around the world if the system behind that screen goes down completely?
Just a moment, performing security verification. We'll leave you with that.